Well, over the past few weeks, numerous announcements have confirmed Austin remains a major tech hub in the US with billions of dollars flowing in for dozens of AI startups, and even a new Amazon robot facility could be coming to Austin soon. I'll share those headlines with you. We're also going to take a deeper dive into some of the stats showing some positive trends in the housing market this summer. Plus, I do want to explain what's been happening with mortgage rates. Why have they been going up over the past few weeks? So, a lot to cover. Let's dive in. Well, just this past week, it was announced that two-thirds of Austin's startup investing is flowing to AI companies, but more importantly, it's how much of the money is coming to Austin. So, according to the Austin Business Journal, in the first half of 2026, Austin area startups raised 6.5 billion in VC funding. And again, that's just the first half of this year. They said if they went back to 2016, one decade ago, for the full year, they only raised 978 million, so less than 1 billion a decade ago. And now, just in half a year, we've had 6.5 billion coming in for AI startups. It was about 87 AI startups quoted in the article. So just know quietly, you and I may not be paying attention, but money is flowing here to get a lot of these companies off the ground. They won't all make it, but even if one or two become a major player, that would be big news for Austin. This is a development project I think everybody should pay attention to. It's called Dog's Head. So in Austin, and you can kind of see the graphic there, it's 2,600 acres. It's east of downtown. I'll show it to you on a map. But basically, the city of Austin just cleared a key funding hurdle. They need to create a tax district so that they can build the roads, build the sewer lines. Basically, this piece of land is just north of the airport. It's probably in the flight path of the airport. Used to be like a mining facility. The whole time I've lived in Austin for 30 plus years, it's just been scrubby nothing. Nobody ever goes there. The Colorado River kind of shapes a dog's head around it. And so now what they're trying to do is create a massive development. It's going to have huge industry. Amazon is the first key player that has been announced. They're going to come and build an advanced robotics facility at this place. They're going to have hotels. They're going to have over 1,000 homes. They're going to have more retail than the Domain. And this is a 30 or 40-year project, most likely. It's just now kind of getting shaped. And no, we're going to go through, a lot of legal hurdles still to come, I'm sure. It's the Colorado River. You're going to have a lot of environmental concerns. So it's got to get through the red tape, but just keep an eye on this Dog's Head, just like we had the Domain, start getting developed 20, 30 years ago in late 90s. Now look at where the Domain is now. It's basically a second downtown. This could be another version of that. This article has a better map of it. So if I show you the Dog's Head, and you can kind of see the shape right here of a dog's head. There's the nose and the mouth, comes up to the eyes, and you got the ears over here. So basically, this is downtown where the word Austin is. See if I can zoom in a little better. You got Austin right there. You come through East Austin, you come out to the 183 loop right there, and bam, there's Dog's Head. Nobody even knows, a lot of people have never even paid attention to this land. If you come south, there's the airport right there, and here's Tesla right there. So it's prime land if they can get it right. So it's going to be interesting to see this property get underway. According to Amazon, this is going to they're going to start their development for this robots facility like as soon as they can, and they're hoping even part of it could open late next year. That would be very aggressive, but if that happens, that becomes an anchor tenant essentially for this development. So pay attention to that one as well. All right, let's do a deeper dive into the housing market. These are 5-year trends looking through June. So we're going to look at the total metro right here. Okay. The dark red line is this year. We're so used to seeing the bottom bar be this year over the past 4 years that now we're starting to see some improvements. So you can see we've had more sales all the way kind of mirroring what we saw in 2023. We're well ahead of the last 2 years in terms of number of sales, not price. But number of sales, that's a good sign. That just means more buyers are buying homes right now. And it's a little below, obviously, pandemic numbers, but better than what we've seen in the past 2 years. If we look at volume, if you just add all the prices up, again, the only year that was better was 2022, and that was COVID. So again, if you add all the volume of sales up, we're doing pretty well there. Here's the median sales price. This is the one everybody pays attention to. Obviously, you can still see the COVID bubble. That'll probably go away by the time we get to a 5-year trend chart next year, because that will be 5 years in the rearview mirror. But right now, if you look at the bottom, our median price had been lagging, but over the last month or so, it stayed steadier, and we've seen sales better than we saw the past 2 years. I wouldn't read much into this. We got to see the full year, kind of see how this line trends out. But at minimum, it's hanging with the past couple years. That also is a good sign. And there we are on average sales price. Again, add them all up. I think the luxury side, or at least the upper middle class side of the market, is probably pulling that up. And so that's why you're seeing that above the last 3 years of sales. But again, good data there for the entire metro. Total listings pretty neck and neck with last year, but not any, there's no sky anymore in between them. If you look at the past 3 years, there was a lot of sky in between each year, just listings piling up. Now, with more sales and not more listings, we're kind of hanging with last year, and we're even starting to see some data that's coming down. And then months of inventory, again, dropping, starting to see a little daylight there. All right, we're going to go to Williamson County real quick. So again, Round Rock, Leander, Cedar Park, all those markets. Home sales, again, above the last 2 years. Strong sales there. Volume up nicely in the middle. Median sales price a little bit above last year, and it just kind of got it in June. So June ended up being an okay month there. But again, we're going to watch that for the full year, see how it plays out. Average sales price, not as strong as Travis County maybe, but hanging in there. And total listings still a little bit above our peak of last year. So still a lot of inventory to work through. They also have more new construction. Pay attention to that in Williamson County, but months of inventory a little lower just because you got more sales. All right, here's Travis County. This is mostly Austin proper, Lakeway. So home sales up, competing with 2023. That's a good sign. Sales volume higher than any year but 2022. Again, that's a good sign, and it hasn't dropped off yet. I do expect, now that we're heading into July, you're going to see how this thing bell curves every year. We're going to start to see that pivot down, but at least it stayed stronger for longer. Median sales price above every year except for 2022. So again, this is not every home, but just know we've had that stronger sales kind of lasting a little longer, got us above the last 3 years. Average sales price higher, and total listings coming down, which means months of inventory is starting to come down. That is a good sign. There's a nice gap there. On months of inventory, we're seeing housing supply start to tighten up a little bit. Finally, Hays County, again, number of home sales higher than any year but 2025. So Hays County, which has a lower price generally, especially on the eastern half, think Buda, Kyle, east of that, those prices coming down. You have a lot of new builds, San Marcos. So that is starting to look good there. Number of home sales volume, though, lower. So again, you don't have as high of a price point. That has kept it lower. Median sales price above last year. So that's a good sign. And average sales price, again, not as high, but still above last year. What they're dealing with is still more inventory. So they're higher than last year. Every year, Hays County has continued to climb. So we got to watch that and see if Hays County can start to tighten up like the other parts of the market. Their months of inventory continues to climb as well. So overall, really good signs. We're seeing housing, more sales, volumes up a bit. Median sales price may have bottomed, at least in most of the market. So we're not going to see any overwhelmingly great numbers here, but what we're seeing is most of the supply is starting to tighten, except for parts like Hays County, maybe a little bit of Williamson County. And so that is something we want to watch for the rest of this year. This is total market right now, active versus sold listings. These are single family homes. If we look at the green line, it's so hard to tell, but there's just a little drop right there. So I think we're going to see that bell curve of listings start to come down. It does not mean there aren't people bringing their homes to market. I'm working on several listings right now. It just means that you're not going to have the volume that you did in the spring when listings piling up, everybody's bringing their home to the market for the spring. We're starting to slow down. You're going to feel buyers slow down. We're seeing listings coming to market to slow down. So pay attention to that. Finally, let's talk about interest rates. Hang on here. We finished last week at 6.81%. And I know several buyers were kind of sticker shocked by that. But the reason is more simple than you think. And it has to do with energy and inflation. And where is all that coming from? It's coming from the war in the Middle East. So ultimately, you got to imagine when the strait gets shut down, that restricts the flow of oil. That means the cost of oil goes up. Well, if the cost of oil goes up, that means inflation, the stuff you and I have to pay for, from groceries to our car or gas. They expect that to go up. Well, if that's going up, then the bond market wants to get a higher return to deal with that inflation. And if the bond market's going up, mortgages go up. It all is glued together. So we've seen that go up. This was our highest price that we saw since this time last year. It's been about 12 months. If I show it to you in a chart, pardon me, if you go back to the beginning of the war, rates were lower, especially over the last 4 years. We were in the low sixes. I think we touched 5.99 at one point. But basically, then the war got announced and boom, rates shot up, to 6.6. Then we thought, oh, maybe this is a short war. It sounds like they're going to work some deals out, have some peace talks, drop back down to 6.32. And then, of course, more shots got fired. And, the war has just been this volatile ping pong, but it shot up to 6.75. And then as the markets get more skeptical, as the oil market realizes it's harder to detangle this issue, rates have kind of stayed inflated, we'll say between 6.5 to 6.75. And then, of course, now the war has kind of picked up a little heat again. More shots getting fired. The Strait of Hormuz is still not fully open. And so what happens is rates shot up. So you got to watch that. If you're watching the news, pay attention to that. If things sound good, just know Wall Street's going to have a positive reaction to that. And you may see rates come down. You may see the stock market go up. The reverse is also true. If the war looks like it's going to get more tangly, it's going to be more challenging, or other issues like this war pop up, if inflation stays sticky, then what's going to happen is you're going to see the bond market stay elevated and you're going to see mortgage rates stay up. So hopefully that is helpful. Well, if you are a seller right now, the good news is if you're coming to market the second half of the year, you don't have quite as much competition. So there aren't as many new listings coming to market with you, but be aware the buyer activity really has slowed down in July. It will probably stay slow in August. Most people are still on vacation or getting their kids ready for school. And more importantly, buyers in the second half of the year don't have as tight of a timeline typically to buy a home. They just want to buy something before the end of the year. And we're kind of early on that. So some buyers will buy, some will be waiting for this fall. If you are a buyer right now, this explains why you're not seeing as many listings land in your inbox every day or every week, because there just aren't as many sellers week by week bringing their homes to market. And of course, stuff you've had your eye on is slowly either getting bought or going withdrawn or expired if they end up not selling the home. So again, hope that is helpful. We'll have updates for you each and every week. Make sure to go to our YouTube channel at Ryan Kelly Group and click that subscribe button. Want to have you follow us there. And of course, if you know anybody looking to buy, sell, or invest here in Austin, now's a great time. Would love the opportunity to chat with you. Anyways, another hot week. I think we hit 100 degrees every day. So I'll bring you another update next Monday and talk to you then.